Hello, everybody. Welcome to another episode of the TF podcast. I'm here with special guest Darren Marble, who has been a part of the TF conferences over the last couple years, and really enjoyed uh, developing a friendship with him and seeing his company grow over the last couple years as well. So, with that, everybody, welcome Darren. And Darren, please introduce yourself.
What's up, Jonathan? Good to see you, man. Hope you're staying safe and healthy in this new normal. But we're live and direct, man. I'm in Southern California, and I'm the co-founder and CEO of Issuance, a financial marketing firm based in LA, offices in New York, and I'm also a co-founder and co-CEO of Crush Capital, which is the creator and owner of the Going Public series. And it's great to be back with you, man. Thanks for having me on.
Yeah, awesome, man. Awesome. I'm excited to dive into those things. I want to touch kind of just how you got into the space to begin with. I know you've been working in the fundraising from the reggae and that sort of side. And, I remember back when ICOs were super hot and everybody was saying how amazing they were. You were very well known for saying how not amazing they were, and it seems like you were correct on that one. So I love if you kind of touch on just how you got into really just the fundraising side of things, and then how that kind of evolved towards digital assets and so forth.
Sure. So I think, like a lot of entrepreneurs, it was really a long, windy road. Was not a straight path, and I think the ultimate truth is we failed into this industry, and we made something out of it. Years ago, we had a company that was marketing Kickstarter and Indiegogo campaigns, and so we created a very small agency-like business, charging fees to entrepreneurs, a lot of filmmakers, in fact, that were raising small amounts of capital to launch their dream company or produce their film or write a book. And we would sell these deals for like $2,500 a month and run a campaign for 2 months, and we give the entrepreneur like a social media marketing resource, maybe a PR guy. And no one was making any money, and yet we were enjoying the work, and it was such a grind that I was ready to kind of walk away from it. We were doing that for about 2 years. I was still in a day job at the time. My co-founder was in a small apartment just struggling, and it just wasn't fun. And literally, as I was about to quit my own business, got into a meeting with the guy who said he wanted to raise money for this, grandiose film project. And this guy had the air of money, and was an entrepreneur from Europe. And so he was talking about his idea for this glorious Kickstarter campaign. And I thought to myself, I'm ready to quit. It's been 2 years. I'm grinding. I haven't made a dime. The people we're hiring are all amateur because we can't pay them any good salaries or fees. Said, what's the fastest way for me to get out of this meeting? And so I literally just cut this guy off, and I said, listen, man, for your project, it's going to be 50 grand because there's so much work we have to do. You have no idea the amount of effort involved. And he says, 50,000, Darren, that sounds like a good deal. Why don't we do it? And that was a game changer, and it put us on a path to charge higher fees and do more interesting projects. And so literally 100 campaigns later, we used that model to transition into the Reggae Plus space and started selling campaigns for, $250,000, $300,000. And then that pivot was really a game changer, and ultimately led to us, being the company we are today as a financial marketing firm, fintech company. But like I said, we kind of got here by accident and serendipitously tried to quit my own business and ended up succeeding despite that.
Yeah, cutting your nose to spite your face or whatever. No, I'm just kidding. But like,
Yeah.
um, I love that story. Do you think before you made that decision, when you're kind of doing that, do you think you were undervaluing the work, or was it that the clientele at that time didn't have the capacity to pay that, or what was the lesson that you learned there?
Yeah, it's a real simple lesson. We were absolutely undervaluing the work. And so what I realized is that when you charge a high fee for your product or service, two things happen. One is client perceives value. because value is associated with high price tags. And secondly, when we were able to charge that entrepreneur $50,000 instead of $5,000, literally 10 times higher, fee structure for us, we were able to hire incredibly talented marketing people, and we delivered a successful campaign. So not only did we actually turn a profit, and we finally, after 2 years, had runway to build a business, but we were able to build a legitimate team and deliver a much better outcome for the client. And we never looked back from that time. And so I've really been testing the upper limits of how much we can sell a crowdfunding campaign for. And, now we've helped companies raise $20, $30 million in Regulation A+ financings. And believe me, we couldn't do that for $2,500. It requires a substantial team and strategy and paid media campaign and technology stack. But it really was the smartest thing we've ever done, and something I'll never forget. And so when I see other entrepreneurs that are struggling to make ends meet, one of the common denominators is usually that they're undervaluing their product, their service, and they should be charging a higher price. And I think people have a fear of changing their pricing for different reasons. They don't think they'll be able to sell. They think they won't deliver, but really the opposite is true. So it's for some businesses, it can be the smartest decision you'll ever make.
Yeah. Yeah. So walk me through the Reg A side. So you were doing the crowdfunding stuff, and then how did you start realizing that there is an opportunity for helping those with Reg A?
We got introduced to Paul Elio, who's an automotive entrepreneur out of Phoenix, Arizona, in early 2015. And at that time, we had a number of successful rewards-based crowdfunding campaigns under our belt. Paul said, "You guys are very unique. I've never met a firm like yours. And I want to hire you, but I don't want you to run a traditional crowdfunding campaign. I've already done that." He said, "I've done that on my own website on eliomotors.com. He said, "There's this new securities exemption called Regulation A+, and I can raise up to $50 million and sell securities to my customers, fans, and new investors." He said, "Would you guys be up for running a securities equity crowdfunding campaign?" And we said, "Absolutely." And so we applied some of the same methodology and strategy and thinking that we had used successfully for some of our largest Kickstarter campaigns to this Regulation A+ campaign. And it turned out to be a huge success and another turning point for the business. When we did that offering, Elio Motors ended up raising about $17 million from 6,300 retail investors or everyday Americans. And then they closed the offer in February 2016 and then listed their securities to OTC Markets Group, OTCQX, specifically where they are currently still trading. And that was just a door opener. I started getting calls from broker dealers, investment banks, underwriters on Wall Street, securities attorneys, audit firms. "Hey, how did you guys do that? How did you raise $17 million out of thin air at this really stepped up high valuation? How did you do that online? How did you do that without an investment bank? What strategies did you employ? Can you do it for this deal? Can you do it for that deal?" And so it was really the foundation for me to build a network and bridge to Wall Street, where we continue to have a number of really incredibly savvy partners that have deal flow, and very bullish on the Reg A exemption in general. What's really interesting, Jonathan, is if you look back, how did this exemption come to exist? Well, it's a securities exemption that was part of the Jobs Act. The Jobs Act of 2012 was really a response and an answer to the financial crisis of 2008. Congress and the SEC put their heads together and said, how can we make it easier for small and mid-sized businesses in the United States to raise capital, access capital markets? And how do we level the playing field for the everyday American retail investors that have been locked out of private placements because they're not technically accredited investors? How do we do these two things at once? And part of the answer was this Reg A exemption, where a company can raise up to soon to be 75 million. They can market their deal, and anyone over 18 can legally invest. Now here we are in 2020. with coronavirus and 16 million people having filed unemployment in the last 3 or 4 weeks, and economy has come to a standstill in many places and industries. And interestingly, we're seeing a surge in Reg A plus deals once again, because now this securities exemption not only exists and has been available for 5 years, but 2019 was actually the largest year on record for this exemption. And so in the past 5 years, about $2.2 billion has been raised by hundreds of companies that chose the Reg A path. And of that 2.2 billion, 1 billion of it came in 2019. So last year was actually the biggest year on record for this securities exemption in terms of the total amount of capital raised industry-wide and the total number of deals. And now we're seeing a huge uptick in companies that are looking for alternative ways to finance their business. And I'll tell you, the most incredible thing is that most of these companies that we're talking to, they're awesome businesses. They're not distressed assets, struggling startups. It's not the first money in. We just signed a deal with a company. It's a wine subscription business, and they've generated like almost $150 million in top line revenue over the past 3.5 years. Really high caliber companies that are looking for creative ways to finance their business in the midst of this chaos. And Reg A Plus is, a ray of light among dark clouds. And so very fortunate to be in this space and excited to continue to help entrepreneurs, raise the capital they need to build their businesses.
Let's take a step back for a second. So what is the Reg A plus? Like, what does that offer that some of the other filings don't?
So it's billed as a mini IPO. It involves a filing with the Securities and Exchange Commission, and it allows a company to raise up to, again, $75 million. They can market their deal, social media, events, you name it, PR. And most incredibly, it allows anyone over the age of 18 globally to legally invest, regardless of whether that individual is an accredited investor. So imagine a company that's doing $25, $50 million in sales. They make a widget. 80% of those sales come online through their e-commerce platform. Let's say they've got 300,000 customers. That company can now become a Regulation A plus issuer and market their investment directly to their 300,000 customers. And they've got another 100,000 followers on social media. We run a marketing campaign and give them access to another 500,000 prospective investors. You can see how these campaigns can quickly raise tens of millions of dollars just from their customer base alone. And the truth is that this exemption in particular, it's not a great fit for startups, meaning pre-product, pre-revenue. If you're building a business and you founded the company in the last 90 days, this is not the right tool for you. You might want to look at a traditional private placement. You might want to look at a regulation crowdfunding campaign, which is the true equity crowdfunding play, and you use a licensed portal. You can raise up to $1 million. That cap, by the way, also increasing to $5 million. So Reg A Plus is really a good fit for companies that have some established history of operations. They have a customer base, maybe they have a brand, or maybe they are earlier stage, but they've got a great story, a story that's going to resonate with a wide mass audience of retail investors. Or maybe they've got distribution. Maybe they have, a wormhole into the matrix, as I say, and they've identified a way to aggressively market their deal and get that deal out to the right investors at a very low cost. But that's really what the exemption is. We've been championing this exemption for a number of years, and everything we do and I do as an entrepreneur is really centered around helping companies raise capital under Reg A plus.
Yeah, no, super interesting. And so on that Reg A plus side of things, would one of those businesses also take money from institution in the Reg A, or would they have to file a different filing for that?
It's a really good question. And the answer is you can absolutely raise capital from institutional investors. And so I can touch on what we're doing with, Crush Capital and the Going Public series. Going Public is an original series that we're launching. And the premise is we follow the stories of 5 founders as they're raising capital and taking their companies public to NASDAQ. And for the first time ever, we're allowing viewers to invest in the IPOs and invest at the IPO price. And when we created this company 2.5 years ago, it's been a journey to put the infrastructure in place because it's quite complicated and requires a lot of different partners all aligned. We never wanted it to be a series where it's just about the little guy putting money into the deal. I always thought it was really crucial to have smart money, to have institutional investors participate in these offerings, and to give the retail investor an opportunity to actually invest alongside those institutions. Because now that deal's been de-risked. So if you have a deal that raises, let's say, $15 million, and 100% of the investors are retail, and the average investment is $2,500. That's great for the issuer, and you'd hope that that company is a good steward of the capital, and they use that 15 million to build their business and deliver returns to the investors. But it's a whole nother opportunity if it's a $30 million deal, and half of it is placed with traditional institutional investors, and then the other half is an allocation for retail, and they invest at the same terms. So that's what we're doing with this series. And the way we're doing that is we've brought in a leading small cap underwriter called Roth Capital. They're here in Southern California. They've helped finance about $60 billion in small cap financings over the last 25 years that they've been around. And so what they've agreed to do for the Going Public series, which will air in January, is to firm commitment underwrite the IPOs in season 1. And by the way, if I didn't say it, we're taking companies public in the show Going Public. So you invest in an IPO. I think I did say it. But Roth is underwriting these deals. And so, again, you take that $30 million example, Roth Capital is going to run their traditional roadshow, take the deal out to their traditional institutional investors, and they're going to get commitments. They're actually going to get commitments for all 30 million, and then they're going to hold the institutions back and say, you know what, the deal's oversubscribed. We can only place 15 with you. Now there's a $15 million allocation for the viewers who every week can watch the series, follow the founders, follow the stories, the drama, click to invest in real time. And that's what we think the perfect Reg A Plus IPO looks like. It's, 50% is allocated to institutions. The other 50% is taken by the everyday American who's watching this series week after week. Deal closes, company lists to NASDAQ, and now everybody's liquid. The institutions have liquidity in their allocation. The retail investor, the little guy, has liquidity in his or her investment. It's a perfect storm. And so the answer is yes, and that's the approach we're taking with this show.
Yeah, yeah, that's awesome. It's super interesting because you hear a lot of times people talk about the average person not being able to get into a deal, right? And so, like Uber goes public, or these big companies go public, and then market price drops, and it's like, well, we don't a retail investor doesn't get to participate in like the early opportunity. And so it seems like the Reg A is like that opportunity for someone to participate, right?
Yeah. Listen, I think it's almost criminal that these big companies raise hundreds of millions, billions of dollars, and they're building their businesses off the backs of retail investors and their customers, everyday Americans, the gig economy workers, the Uber driver, the Instacart shopper, people that are charging these electric scooters. These companies go public, Jonathan, and all the value has been sucked out by the time the company IPOs. And who makes money in those deals? The seed investors going to make a killing, 1,000x returns. And it's the biggest grand slam of their career. Never work again. Generational wealth has been created. You've got your Series A, B, C, D, E investors. They all do great too. So who's left holding the bag? It's the little guy. When these companies go public, a lot of times there's nowhere for that stock to go but down. And so I think that's really unfortunate and even criminal in some ways that these companies are not allowing their customers to be a part of the financial opportunity associated with the IPO. And they're kind of suckers, and they're marketed these shares by a number of financial institutions. And there's not a lot of value left because these companies, they're bloated, they have stayed private for way too long. If you look at a company we're all familiar with, Amazon. When Jeff Bezos took Amazon public in 1997, the company didn't raise $1 billion. You know how much they raised? Any idea?
I think it's $1 million, right?
They raised $54 million in their IPO.
Oh, sorry. I was thinking his initial seed round
was $1 million. So the seed round was $1 million. 20 people, 20 lucky investors put in 50 grand, and they all became billionaires.
Yep.
But the IPO was only $54 million.
Interesting.
And that's what a small cap IPO is. And you look at the gains, I think it's like a 250,000% gain had you invested in that IPO. But that's really the definition of what a small cap IPO is. And that's what we want to bring back. And not only do we want to bring that deal back, we want to allow the customers of that company to invest in the IPO and have the opportunity to create that kind of wealth for themselves long term. It's a long term play. That was 20 plus years ago, but you don't see a lot of deals like that anymore. And so that's part of our ethos, is to allow the retail investor an opportunity where they have substantial upside. And that upside is investing in the IPO for a smaller company that has a lot of growth potential and upside. That opportunity is definitely not investing in the Uber IPO after the company goes public, after the shares pop or drop. That's not a great opportunity for the average retail investor. And so we're here to change that. And really, it's a core value and something we very strongly believe in, and are excited to bring that innovation to the market.
Yeah, no, I think that's great. How do we ensure or support or help the retail investor to be sophisticated, one, in the investment process period, and then two, in the actual company? I'm assuming, like, by Reg A, like, there's certain things you need to make available for all investors, but because that's often used as an argument, right? It's like, hey, you have professional investors, that's why they're getting in. There should not be a retail investor because they just would lose their money or they wouldn't know how. What's the education or the argument about that?
Listen, I think there's this phrase out there in capital markets, and they say, oh, retail investors, dumb money. And I use the term smart money to describe an institution. I really dislike the term dumb money. I think it's not fair. I think it's a misnomer. I think the average investor is not as dumb as people think. So let me go off on a tangent here. Dumb money, SoftBank, $16 billion loss. One of the largest venture capital funds, private equity funds in the world, thought these guys were smarter than anyone, and they made their big bet in WeWork. So the idea that there's some group of investors that are smarter than everybody else just continues to be proven false, generation after generation. It's not the first time we've seen that happen. It happens a lot. But to your point, education is critical, and not every retail investor knows how IPOs work. In fact, most don't, because they have never had the opportunity to invest. So why would they be educated about that? So again, part of our values and our ethos is to provide ample education to the viewers of this series as they're watching the show progress. They're watching the founders raise capital and go to NASDAQ and talk about, the terms of the deal. There's two things. One, similar to Shark Tank, the deal has to be deconstructed. The IPO has to be made simple. And there's a way to produce this series in a way where we do simplify the deal and the terms, but moreover, the investor needs an opportunity to dig in. So if somebody's looking for real answers and they want to peel the onion, they can do that in a multitude of ways. They're going to be able to do that through our site, goingpublic.com, which will have a vast library of educational content and materials, both written and video. And they'll be able to click through to the issuer's offering circular, which is required by law for us and for the issuer to share on any investment site or platform, so that if they want to look at all the disclosure and risk, they have that very easily accessible to them. Now, beyond that, this it's an opportunity for us to kind of showcase what happens in the investment world. So throughout the series, there are a number of mentors that come in and interface with the company and provide feedback to the founder in real time about their deal, their company, the investment, how to close the deal, how to raise more money, express concerns, provide guidance, strategy. There's also investors. So we've got a number of billionaire investors that are clawing to get featured in this series, playing themselves, of course. And we're going to show the entrepreneur meeting with, let's say, Chris Birch, retail billionaire, co-founder of Tory Burch, who's out in New York. And the entrepreneur gets to pitch Chris at his office in Madison Square. And they'll be able to negotiate a deal in real time. And Chris is providing critique the same way you see, Shark Tank investors provide that critique. That can be a signal as well to the viewers of the series and may influence their decision. If someone like Chris puts in $3 million into the IPO and he's excited about it, that might signal to the woman who's, got $1,000 to invest in the deal. Maybe she puts in because Chris did, and she's had an opportunity to really understand the business because she's been watching this show for week after week. The bottom line is education is critical. That type of education needs to be baked into the series. It needs to be baked into the platform. That's our full intent and plan. And we want to do it in an entertaining way so that it's a fun format, easy to follow, and something you can get excited about.
Yeah, no, that does sound super interesting. And right, if you're going along with someone throughout the show, you should start to develop a better understanding of why that deal could be interesting to you overall. And then it makes you think. Now it's going to sound like I'm plugging this, but it makes you think that like all Reg A pluses should be going through this process, right? Like, or at least have some version of this, like a highlight reel, to really understand like what people are putting their money into. So super interesting. I'd like to take it to what's kind of been happening in the market overall, right? So I'm assuming you have lots of opinions here, but about a month ago, stock market goes down about 30%. We've slowly been inching up from there. I think the market's like at somewhere around 2,300 right now. What are your thoughts overall on that when it comes to one, how fast the money came out, to the bailouts that are happening, and are things being overvalued or overinflated right now based off of speculation, or what are your thoughts overall?
Well, look, I think it's the market dropped so quick and so suddenly. I think it's been devastating for a lot of people, millions of Americans that don't have a lot in savings, have no savings. It's really tough, and yet when there's a lot of fear in the market, as they say, that's maybe a time to be greedy. When others are fearful, be greedy. And I do think that if you're in the market or you are not in the market and you've been thinking about getting into the market, now would be a great time. And if you look at this market with a long-term lens, that you're investing for the next 3, 5, 10 years, I think America's on sale right now. And again, I don't think you should put money into Starbucks or Disney and try to double your money in 6 months or a year. But I think there's some great American businesses that are undervalued, and therefore are opportunities for retail investors to start considering putting their money into slowly. And again, with a long-term lens, that they're going to invest in businesses that they know, maybe they use their products or services, did use their products or services on a regular basis, and willing to kind of park that money and walk away and not think about it for a couple of years. So I do think a lot of these companies are on sale right now. That's an opportunity. And, you know, I don't know if we've hit the bottom either, Jonathan. I think we have not hit the bottom personally. I think, if you look back at all the other recessions and depressions in the last 100 years, usually the first bottom is not the real bottom, that we test and then we retest weeks or months later. And so my concern is, as earning reports come out for these companies, we're going to see how devastating this economic collapse has really been for a lot of businesses. Mm-hmm. And I think people are aware we're seeing like incongruent messages. And I think there's memes out there. You'll see like Jim Cramer on CNBC. He's talking about opportunity to buy stocks, and stocks, these deals could be going up. And then there's a headline on the screen and it's like 16 million people filed for unemployment. Or you see the 16 million people file for unemployment and then the Dow is up 2%. And so you're wondering, how is that possible? How is there such massively negative news? And yet the stock market is increasing, and some people say, oh, it's priced in, and all of that negative headlines been priced in. I don't know if that's the case. So I do think that there's risk that we retest the bottom in the next few weeks or even months. And it's just really unfortunate. We don't know what's going to happen with this virus. Maybe there is a flattening of the curve, but maybe, Jonathan, if we get back to work right now and everybody reopens the economy and governors reopen their states, maybe there's another wave of this thing. And I think that's a very real possibility from what I'm reading. And I don't think there's any easy answers. Ultimately, I'm a long-term, I'm an optimist by nature. I think we will get through this, but I think the recovery is probably years in the making. And therefore, if you're going to invest in this market, you have to have a long-term perspective, be willing to park your money and walk away. If you have the discretionary funds, if you have funds available even in the first place to invest, because I don't think you're going to see this market turn around overnight.
Yeah. Yeah. It's, this isn't financial advice, by the way. We don't give financial advice. This is just, our opinions, but I agree. I don't think we've seen the bottom yet. I'm probably not very qualified to talk on that, but for me, it's just natural. When you think about the fact that Q2 earnings haven't come out yet. And like you said, they're likely going to be pretty devastating when, no one's shopping. Retail, I think today it came out that retail sales are down 8.7%, I think is what it was, which seems, that doesn't seem like enough. It feels like it would be more. But now I'm like pulling it up really quick. But yeah, and you just think about, I've spoken to a lot of small business owners in the Seattle area, and they're like, yeah, we have maybe like 15% of our sales right now. So, yeah, I agree that it's probably, we're probably still in this for, there hasn't been I don't remember a time where there was a correction so quickly either from, studying it, and even like the 2008 recession, right? It took a little bit longer. So like for people to think that we're just going to go ahead and clear up the loss and get back to 30,000 or whatever it was at, just doesn't feel natural. We talk a lot about Bitcoin and crypto on this show. I actually want to take a step back and go back to the whole reg stuff for a second. And, what are your thoughts, or not what are your thoughts are, like, how would you compare, I guess, Reg A or even any of the regulation filings to like when people were doing the ICO, just for like a level setting? So for those that were familiar with ICO, like, hey, like people were saying like, oh, these are SAFs, or these are securities, or they're not securities, or whatever. Give us just a quick, we don't have to spend a ton of time on that, but give us a quick education on that.
Well, look, I think the biggest miss in the ICO space, and this was, of course, by design, it was intentional, is that the investor had no visibility into the company. They had no visibility at all. And that's because these companies intentionally provided little to no disclosure. And if you look at capital markets and all of these securities exemptions, there's some form of disclosure required for any type of capital raise. There's less disclosure required for a traditional private placement where you raise money from accredited investors, because in theory, although I don't agree with this, people with more money, higher net worth, they're smarter, they know what they're doing. And then where you have the most disclosure is like a traditional IPO or a mini IPO with Reg A+. There's 300 pages of disclosure because the SEC wants the average investor to have an opportunity to understand precisely what they're investing in and what the reality of the business is from a financial perspective and from a dilution perspective. How much will they own? All of these things were murky in the ICO world, and so kind of created like this lemon market, and it encouraged a slew of shady issuers and shady people to go out and do shady deals where the investor in the deal was generally a sucker and bound to lose 90% to 100% of their investment in these deals.
And that's frankly, that's what we've seen, right? We've seen a ton of these companies that have ICO'd that have lost 90% of their value.
Yeah, and look, I mean, you've heard me say it. People are like, oh, well, let's go to Malta because the government of Malta, they're really pro ICO, and they get it, and they're going to get behind this no disclosure capital raise. You know what I say to those people? Get the fuck out of here and go to Malta. Get out. Take a one-way plane ticket and don't come back. There's a reason that we have the most robust capital market system in the world. Despite this economy, it's still the US. That's because we have a set of rules and regulations that are designed to protect investors. And so when you walk away from those protections, you get a bunch of shitheads that run scams. And that's just the nature of the beast. There's no fantasy land where people self-regulate and everybody falls in line and does the right thing. No, people take advantage of the opportunity to skim from the top, to bilk investors from their hard-earned money. And that's what happened in the ICO market time and time again. And it's just really unfortunate. And so I always thought it was a farce, the idea that there were these, governments and jurisdictions outside the US that were more crypto friendly. And listen, there are, but again, if that's what your ethos is and you want to go be a player in that space, then go leave this country and go live out somewhere else and see what it's like. Mm-hmm. Go be a citizen somewhere else. Because I think that is generally a dangerous space, and it's a dangerous way to play the game when you don't require the issuer, the company that's selling securities, to provide any disclosure about their business. They can basically lie, cheat, and steal. And when given the opportunity, a lot of these people have done that. And what ends up happening is billions of dollars are scammed, billions of dollars are lost in fraudulent investments. And then the con artists run away with your money and they disappear. And you have no recourse because you didn't buy a security, you bought a token, and your token has no rights and you can't vote. And you probably don't even know where this company is truly based. You're doing this online. So that's an important framework that we have here. It's part of the reason that our capital markets work so efficiently. And we're very fortunate, honestly, to have a Congress and the SEC and Chair Clayton that has continued to deregulate and continue to allow for easier ways for companies to raise capital, but within reason. There's still a disclosure involved. There's still a filing involved in the Reg A+ side. And by the way, these filings, let's be clear, I'm not telling you that just because somebody does a Reg A+ deal and goes out and tries to raise $15 million doesn't mean you can't lose some or all of your money as an investor.
Right.
At a minimum, you've had the opportunity to understand what the risks are. You've had
Yeah.
an opportunity to view the business in its entirety. And that is what's important. So it doesn't mean that you have no risk. It just means that you have an opportunity to understand the risk.
Yeah.
That's what makes this system work.
Yeah, definitely. What are your thoughts then on, like, Block One and some of these companies that did do ICOs, and then they basically just got, hand slaps when it comes to their fines, right? So like Block One, they raised $4 billion, and like the ever going ICO over like a year, and then they basically had to pay 24 million, and everything's fine.
Listen, I think it's ultimately, to your point, it's a slap on the wrist. That company can afford to pay a $24 million fine and probably celebrated when they did, because it's such a small fraction of the billions of dollars that they raised. And at the same time, I think the SEC did what they had to do. They've continued to, set precedent and make examples and show this market that there are consequences for not providing adequate disclosure, for selling securities in the form of a token. And so, I'm not an expert in Block One. Admittedly, Jonathan, I've moved out of this space almost completely. As at one point, Issuance was actively participating in the digital security space. Digital securities were billed as a compliant alternative to initial coin offerings. And we were proud to be in the space and a player in the space, and had done a number of deals, compliant deals. But it was evolving at such a slow pace. And what I found at the end of the day is that the investor demand for digital securities was just not there. We had a lot of companies that wanted to raise capital, but very few investors that wanted to put their money into a digital securities offering. And so for those reasons, we basically walked away, and we just doubled down and kind of went back to our roots in Reg A Plus and started working with more traditional businesses and traditional offerings. So, I have hopes for that industry, but truthfully, I haven't read an article about Tezos or Block One or even digital securities in many months. And, it's been a grind for a lot of those companies. There's really a handful of companies that have had success in the space, and maybe that's the way it was meant to be. But I think it's a tough market. I think the whole crypto market is a question mark in my mind, and I'm just not sure where that industry is headed right now. Obviously, there continue to be bulls and Bitcoin bulls and maximalists, and some of those things are still there. And I definitely see it on my Twitter account. So I see crypto Twitter every day. I'm just not in it the way I was before, and
Yeah.
we just moved out of it.
We've never really talked Bitcoin, you and I. Like, what are your thoughts? How has Bitcoin impacted in all of this? Or it's kind of same thing. Is it something that, are you moving away from Bitcoin as well, or?
Yeah, it's interesting. So me personally, I've been more of an observer than anything else. At one point, I owned some BTC, I owned some Ethereum. Don't have those assets or holdings anymore. I don't know. I don't know what's going to happen with Bitcoin, and I'm not a person that has a very clear forecast there. On the one hand, you would have thought that this would have been Bitcoin's moment to shine. That for years and years and years, all of these people are saying Bitcoin is digital gold, and it's the next big thing. And why hasn't it shot up to $15,000, $20,000, $100,000 right now in this economy? Isn't this the market that Bitcoin was supposed to thrive in? When there's inflation, the government is literally printing trillions of dollars.
Yeah.
Weren't these the things that were supposed to make it explode in price? But it hasn't happened. What's it at today? $6,500 per Bitcoin?
Yeah, it's like somewhere between there and 7,000,
It's
7,200.
up, it's down.
You
I
know
would
what?
have thought it would have been higher. So I'm at
So
the moment, I'd say I'm skeptical, but who knows? Maybe it takes a recovery. I'm not sure. I thought these were some of the triggers that were supposed to fuel the price of that asset, and
yeah,
it
no,
hasn't happened yet.
it's funny. I mean, there's definitely people way more qualified to support or defend that than me. But my thought, I never, I think there's opportunities for Bitcoin to be a safe haven in the future. I always had trouble thinking about Bitcoin being a safe haven during these times for the only reason that it hadn't been battle tested yet, right? Like it hadn't experienced a economic recession from its creation. And so I was under the impression that it would go down if other things go down. To be honest, though, I've actually been pretty encouraged that it hasn't shot up, and I'll tell you why. Because for me, it feels like it's showing to be a little bit more stable, right? Like we've always talked about how Bitcoin is like the super volatile asset, and like yeah, it shot down to 5,000, got cut in half basically. But since then, it's been either steadily growing or essentially like maintaining at itself. So for me, and this is again not any sort of advice, but for me, where I get encouraged is like I'm actually encouraged that it's staying there.
Sure.
If it shot up to 15, I would be like, well, fuck, here comes the whales or here comes the institutions to manipulate the market, right? Like, because I wouldn't think of it as like, oh, there's a bunch of average Joes putting money into here. So I don't know. I'm still bullish on it. I think for me personally, like I think of it also as like what you're talking about, like with the reggae or the other stuff is like I think about it from like the long term perspective. So for me, I don't really care if it goes up by 1,000 or down by 1,000 because I care about Bitcoin, at 100,000 or whatever it could be in some hypothetical future. But
Well, listen,
yeah.
I agree. I think if you're bullish on Bitcoin, um, or you want to get into the market, and again, I'm not giving advice either, but if you're going to buy Bitcoin, hold on to it. I have the same perspective there as I do in terms of the stock market. The entire market is volatile. Bitcoin's volatile. The market's volatile. If you're going to play in this market, be aware that there is risk. There's going to be continued volatility. We don't know if we've hit a bottom, and be a believer. Hold on to these things. Don't be a day trader. Don't be a swing trader. Hold on. Put it in for 3, 5, 10 years, and then check back then. That to me is a better play in this market than anything else.
So I saw this thing recently where Warren Buffett bet some hedge fund $1 million that if he could outperform them on on their trading, essentially, if just by investing in what do you call it, the S&P, basic.
Sure.
If he's like, if I just invest in the S&P for 10 years versus like what you guys do, I'm going to outperform you. And supposedly he did like 10% return or 9% return or something like that. And then the hedge fund got 3%. And so that had me thinking, it's like, for those of us who are not traders, we probably would do, or wannabe traders, we would probably do better, yeah, just holding it for 10 years than like buying and selling and buying and selling and buying and selling overall, right? So we'll see.
I think that's
At
the
least,
right play for the average. I think the right play is long term for the average investor in this market.
yeah. Yeah, totally, totally. Well, Darren, I want to give you time to close it down. What's something you want to leave our audience thinking about as they go about our day, or a question you want to ask for them as they kind of go about what they're doing today?
Um, look, I would encourage people um, to stay positive. And it's just so rough out there, Jonathan. We're seeing a lot of doom and gloom, and I think Americans are resilient. We're innovators. We're resilient. We're exceptionally diverse. That diversity gives this country strength and hope. And so, as bad as it is, we will get through this. And it may not happen in months, it may be years. Hopefully, it's not. Hopefully, this thing snaps back and the economy reopens and we get a grip on this thing. And I think we're going in that direction. But, I'm sympathetic and I have empathy for people that are really struggling, because there's a lot of people that are under economic duress. And I think the most unfortunate, like the saddest thing with this market is this whole virus thing. It is punishing companies randomly. You could have a great business and you've done all the right things and you're in retail and you've got a shop and you're done. You've lost 95% of your revenue. Like you said, it's striking at random and it's not fair. It's unfortunate. And I think it's really frustrating. But I think we as a country are going to get through this. And, to the operators that are entrepreneurs and running businesses, we need to do our part. You're doing your part, I'm doing mine. I encourage others to keep their head up and just to be as resilient as possible and to do their part and continue to, run their businesses as best they can, try to find opportunities. If they need to pivot, if they need to create a new line of business, a new revenue stream, a new product or service, there's never been a better time to innovate, to try something new than right now. And so, again, I'm an optimist. I encourage other people to be optimists. And I know we'll get through this, and looking forward to getting through and to the other side.
Yeah. Awesome. Awesome. Good words. And I agree. I think, yeah, so staying positive, which, might sound silly to some, but it's kind of, for some, it's the best that we got. And, just exactly showing empathy and support for people. I've said this a couple of times, is it's not a snow day, right? Like, so it's not like there's a blizzard and all of a sudden that blizzard's going to melt away. It's like, hey, like this has some impact. So
No doubt.
well, Darren, what's the best ways that people can get in touch with you or follow you or stay in contact with you?
I'm on LinkedIn at Darren Marble, Twitter, same. My email is darren@issuance.com. It's DARREN at issuance.com. And Jonathan, it's such a pleasure to be on your podcast. And I commend you for doing your part and fighting through and highlighting operators and entrepreneurs and perspective in the space. And you're just bulldozing through, man. So keep up the great work. And always a big fan and advocate for you and TF. And really appreciate the opportunity to be on and talk with you.
Yeah, thanks, man. I really appreciate those kind words. It's been great having you on today, and I'm excited to see what you do. I'm excited for the show as well. And for those listening, thank you again for listening. Make sure that you are following us at TF Blockchain or me at JG Product, and make sure that you please subscribe to this recording wherever you're viewing it, whether that be Periscope or YouTube, as well as subscribe on our podcast channels. Thank you so much, and we'll see you all soon.